Absa chairperson Sello Moloko is set to step down. He will exit the group on July the 15th. The bank says Moloko will do this to focus on his business interests and community commitments. Rene van Wyk has been selected to step into the breach. He is currently a non-executive director and served as interim CEO at Absa back in 2019. DRDGold has posted a 12% drop in output during the mine's third quarter. The firm's also reported a 13% fall in sales volumes for the period. It's attributed the declines to heavy rainfall, which disrupted the group's Gauteng gold mining operations. Given the decrease in tonnages and yield in the quarter, DRD expects to fall slightly short of its full-year production guidance. And as a result, it may also exceed its revised cash operating unit cost guidance of 870,000 rand per kilogram. Datatec expects its full-year earnings to be as much as 83% higher. That's thanks to a strong performance from its Westcon International and Logicalis International businesses. The international ICT company will release results on the 27th of May. Investors have given African Rainbow Capital Investments' plans the nod of approval. At a general meeting of shareholders, almost 94% of voting shareholders approved the resolution to delist the company. This will result in the firm exiting the JSE and A2X. ARC Investments says this should happen on the 29th of May. Shareholders also approved the resolution to re-domicile the group to Mauritius. A timeline for that has not been given, as the move is subject to regulatory approvals. Finance Minister Enoch Godongwana has shot down the idea of a wealth tax. Responding to a parliamentary question on the matter, Godongwana emphasized that the tax base of high net worth individuals in South Africa is small and mobile. And so the introduction of a wealth tax could prompt individuals to change tax residency, and that would harm the fiscus. South Africa's wealthy paid 7 billion rand in personal income tax alone last year. The Financial Sector Conduct Authority has detected significant disparities in the fees charged by different banks for the same or relatively similar products or services. And so the FSCA plans to assess the transactional fee practices across registered banks. This will help determine whether further regulatory or policy interventions are required. Further afield, U.S. Treasury Secretary Scott Bessent and Chief Trade Negotiator Jameson Greer will meet China's economic Tsar He Lifeng in Switzerland this weekend for talks that could be the first step toward resolving a trade war disrupting the global economy. Let's take a look for more detail.
Chinese stocks got a boost Wednesday on glimmers of hope that a trade war with the US might just be set to ease. Benchmark indexes in Hong Kong and Shanghai were up around 0.5% by early afternoon. That followed news the day before that the US and China will hold talks in Geneva on Saturday. US Treasury Secretary Scott Bessent and Chief Trade Negotiator Jameson Greer will meet Beijing economic Tsar He Lifeng. The meeting will come after months of escalating tensions that have seen both sides impose tariffs way in excess of 100%. Now the two countries are expected to discuss reductions in the broader levies, as well as possible exemptions for specific products. Speaking on Fox News, Bessent said he thought the talks would focus on de-escalation. Appearing earlier Tuesday in Congress, he said no negotiations were yet underway with Beijing, but raised hopes of deals with other countries.
I would think that perhaps as early as this week, we will be announcing trade deals with some of our largest trading partners. They have come to us with very good offers.
However, Trump himself sent a slightly different message, saying he would review any potential deals over the next 2 weeks before deciding which ones to accept. Chinese officials confirmed the country would re-engage in talks, while also warning there could be no deal if there was any attempt at coercion. Beijing has previously said it would never kneel to what it has called US blackmail. But economists predict the trade turmoil could sharply cut global growth, ramping up pressure for some kind of agreement. Analysts at Japanese bank Nomura have predicted the tariff wars could cost China some 16 million jobs.
And Skechers has agreed to be taken private by 3G Capital for $9.42 billion in the footwear industry's biggest buyout to date, exiting public markets after 26 years as the popular shoe brand grapples with the impact of steep US tariffs. Here's more detail in this report.
Skechers is to go private. The sneaker brand has agreed to be taken over by investment firm 3G Capital in a deal valued at $9.42 billion. That marks the biggest ever buyout for the footwear industry. The move will see Skechers shares stop trading after 26 years on public markets. Its stock jumped 25% on the news, but is still down on the year. The company last month withdrew its financial forecasts, warning that it faced a big hit from Donald Trump's 145% tariff on imports from China. That country accounts for the bulk of its shipments to the US. One analyst told Reuters the new deal may have been accelerated by the volatile trading environment, with Skechers possibly keen to navigate the turmoil away from Wall Street scrutiny. The company has joined rivals Nike and Adidas in urging Trump to exempt shoes from tariffs, saying the levies will just hurt shoppers. Skechers was founded in California in 1992 and has come to be known for its comfort-focused shoes. It has held up against Nike and new rivals like Hoka thanks to aggressive global expansion and value-led pricing. It has also done prominent marketing tie-ups with celebrities including Britney Spears and Kim Kardashian. 3G Capital is controlled by Brazilian billionaire Jorge Paulo Lemann and is best known for investing in food firms like Kraft Heinz.